Despite rate hikes being a major contributor to the collapse of 3 U.S. banks, the U.S. Fed announced yet another one.
They grew the bank very quickly.
This time of 25 basis points, taking the interest rate in the country facing a banking turmoil to the highest since late 2007.
We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk, and these are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier.
The 9th consecutive rate hike is aimed to bring inflation down to the Fed's 2% target from the current 6%. But the Fed signals that the hikes might be near their end.
We no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate.
The U.S. Fed has been hiking interest rates aggressively since March 2022 to control inflation. But that poses a major risk to banks. A rise in rates brings down the value of government bonds that major banks invest in. That means banks have to bear losses if they sell these low-priced bonds in times of a cash crunch. This has been pegged as a major reason behind the collapse of 3 U.S. banks. And another rate hike further adds to risks of more banks failing. The decision of the world's biggest economy has a ripple effect on India as well. The Indian markets fell 0.5 as higher interest rates make borrowing expensive, reducing investors' appetite to take risks in the market. The Fed's rate hikes also fuel fears of a recession, as rate hikes hurt economic growth. With high inflation and recession fears coexisting, the US and many major global economies have a tough balance to strike. Priyanshi Sharma for NDTV.